Today's topic is single entry. First, to understand single entry, we need to understand what is an accounting equation. Liabilities is equal to asset. This is our basic accounting equation. Now, liabilities can be broken up into two simple parts: equity plus other liabilities. Other liabilities includes both short-term as well as long-term liabilities. Now, equity can also be called capital. So this becomes our accounting equation, that is capital or equity plus liabilities is equal to asset. This is our final accounting equation. Normally, we prepare trading account, PL, profit and loss account, and then balance sheet. This is known as the final accounts. These are prepared in case of manufacturing units. So if I have got a manufacturing company, so they perform various accounting practices and they make a trading account, a PL account at the end of the year, and then we have a balance sheet where equity and liability is equal to the assets. But in case of single entry, these accounts are not prepared. But trading accounts, through the trading accounts, what we get is GP, gross profit, or GL, that is gross loss. And this is used again in the PL account, and through PL account, we get net profit or net loss. So we can say that we perform all these accounts, we prepare all these accounts to get the GP or NP. And then we, in the balance sheet, we write it in this manner. Under the liability side, we write capital and then we add the net profit. If we have net loss, then we deduct the net loss. Then we list all other liabilities, and in the asset side, we list all the assets and then we match both of them and the figure is the same. So this is how balance sheet is prepared. But in some cases, in case of single entry, we have to get this net profit without performing the trading account, PL account, and all of this. So let's take an example to understand this better. This is a sum of single entry. The sum says assets and liabilities of Mr. X as on 31st 12 2019 and 31st 12 2020 are given. You can see assets are given: building, furniture, inventory, sundry debtors, cash at bank, and cash in hand. And liabilities are given: 1 lakh, loan, then 80,000, and then sundry creditors 40,000 and 70,000. It's also stated that decided to depreciate building. So depreciation building is 2.5% and 10% depreciation on furniture. There is also one life insurance policy of the proprietor which had matured and we had got 40,000 out of it, which he had retained. Retained means he has kept it in the business. Retained in the business. Proprietor took 2,000 per month. It means for the personal use, so this is treated as drawings. First, we have to prepare the statement of affairs. Statement of affairs, the pro forma looks something like this. This is a simple balance sheet, liabilities and asset on both sides. But then the amounts for 31st 12 19 and 31st 12 20 are given. Just the way in the question is given. Now we have to pick the assets and write it on the asset side and pick the liabilities and write it there on the liability side. So we can see there is asset building 1 lakh and furniture 50,000. Let's write it asset side. Building 1 lakh and furniture 50,000. Then let's move to the other assets. Inventory, which means stock, 1,20,000 and 2,70,000. Let's write it. Inventory. The amount was 1,20,000 and 2,70,000. So 1,20,000 and 2,70,000. Then let's move to the other asset, that is sundry debtors. It is 40,000 and 90,000. So debtors 40,000 and 90,000 for the next year. Then we have got cash at bank, 70,000 and 85,000. So cash at bank 70,000, and the next year it was 85,000. Next we have got cash in hand, 1,200 and 3,200. There are no other assets remaining, you can see. Now see, there is two figures missing, building and furniture. You can see building, it is depreciated for 2.5% and furniture 10%. So 1 lakh building is to be depreciated by 2.5%. Let's calculate. 1 lakh into 2.5%, which comes to 2,500. So 1 lakh need to be deducted. 2,500 need to be deducted from 1 lakh. So we get 97,500. We are going to write it over here in the next year after depreciation. Next, furniture 50,000, it was depreciated at the rate of 10%, you can see. So 10% depreciation deducted from furniture, so we get 5,000. So deduct 5,000 from 50,000, we get 45,000. Now in the liability side, we are given loan and sundry creditors, but we know liability is equal to capital and other liabilities. So let's write capital first, but the figures are not given, so we'll find it out. We will write the other things, which is loan and sundry creditors. So let's write loan and sundry creditors. I'm writing as creditors. Now loan is 1,80,000, and creditor is 40,000 and 70,000. Okay, now you can see we need to balance. Okay, assets are equal to liabilities, so let's add. You can see the balancing figure will be filled up here in the place of capital. Add add this side. Building is 1 lakh plus furniture, 1 lakh plus furniture 50,000, it comes to 1,50,000 plus 1,20,000. Let's add 1,50,000 plus 1,20,000 plus 40,000, 70,000 and 1,200. 40,000, 70,000 and 1,200. It comes to 3,81,200. Write it here. Write the same figure on this side as well. Now we will calculate this. 97,500, 45,000, 97,500 plus 45,000 plus 2,70,000, 90,000, 2,70,000 plus 90,000 plus 85,000 and 3,200. It comes to 5,90,700. Write it over here. 5,90,700. Write the same figure here. 5,90,700. Now we have to find the balancing figure. You can see here there is 1,40,000. So 1,40,000 deducted from 3,81,200. Let's do it. 3,81,200 minus 1,40,000 comes to 2,41,200, and the next 5,90,700 minus 80,000 and 70,000. 5,90,700 minus 80,000 minus 70,000. It comes to 4,40,700. Let's write it over here. Now we have got both the figures. So this is basically the balancing figure, that is capital. So with this we have got the opening capital and the closing capital. Now remember that the increase in capital is not only because of net profit. So let's write a note, that is the opening capital, which means the capital with which we are beginning the year, and the capital which we are ending the year, this is the closing capital. And the difference in this is not necessarily only because of net profit or loss. There can be number of other reasons as well. Opening capital increases when we have net profit, so opening capital is increasing, so it's add. If we have net loss, it decreases, so the opening capital is decreasing in case of net loss. If we have got additional capital, new capital introduced in the business, it also results in the increase in the opening capital. If you have got any drawings, withdrawal of capital for personal use, that is called drawings, then this results in the decrease in the capital. Similarly, interest on capital is treated as the same way as new capital is treated, and interest on drawings is also treated the same way as drawings is treated. So these are the reasons which causes a change in the capital balance from opening to the closing. Now we have to write what is the profit. You have to find out, determine the profit. For this is basically the pro forma, the general pro forma. Over here we are going to start with the capital balance on 31/12/20, which is also called the closing capital. So we are going to start with the closing capital. So what is the closing capital figure? You can see 4,40,700. Let's write it over here. 4,40,700. Then we have to check if there is any fresh capital introduced, that is deducted. Why is it deducted? Because this was performed in case of we want to reach from opening capital to the closing capital, but right now we are starting off with the closing capital and we are moving towards the opening capital, so we are going this way. So you can see, if we are going the other way around, this way, then whatever is added is actually needs to be subtracted now, because we are doing a back calculation. So capital increases, fresh capital basically increases the opening capital. So from closing capital we have to reduce it, deduct it. So see if there is any fresh capital introduced. See the question. Directly it's not written fresh capital, but we can understand. See over here, one life insurance policy of the proprietor was matured during the period and the amount of 40,000 is retained. So 40,000, which was an insurance policy of the proprietor, he has got that money, but he has retained it in the business itself, has not withdrawn it for himself. So that is why 40,000 is treated as an additional capital or a fresh capital. So we need to deduct it. Always write the figures to be deducted in brackets. So this is how we write it. The next thing that we get is drawings. Do we have any drawings? Let's read the question. Yes, there is. Proprietor took 2,000 per month. So in 12 months, 2,000 into 12, that is 24,000 is the drawings. So we are going to write it over here. Drawings is to be added, so we will not use any brackets. We'll write simply 24,000. And lastly, we have to see the capital balance, because if you're starting off, we want to find out what is the net profit, then for that we have to actually deduct the capital we had started with, because that was already there, existed. That is why capital balance as on 31/12/19, which is the opening capital, that needs to be deducted. Opening capital was 2,41,200. So that needs to be deducted. We'll write it within brackets. 2,41,200. Now we are going to perform the simple calculation, addition and subtraction. So we have started with 4,40,700. 4,40,700. See, we have to deduct 40,000. So deduct 40,000. Then we have to add 24,000. You can see we have to add 24,000. And then we need to deduct 2,41,200. So let's deduct 2,41,200. So we get 1,83,500. We're going to write it over here. 1,83,500. So this is basically my net profit. If this was a negative balance, then this would have been treated as a net loss and not profit. That is how you perform a sum of single entry.